Hey there, and welcome. Today, we are going to cut through all that noise, all the confusion, to give you a really clear, actionable guide for successfully investing in property. Sound good? Okay, let's jump right in. I mean, you've seen the headlines, right? One minute, the market is absolutely booming, and the next, a massive crash is just around the corner. You're hearing about interest rates, inflation, population growth. It's enough to make your head spin. It can feel, well, completely overwhelming. So, how is it that some investors seem to get it right time and time again? Well, here's the secret. It's not about luck, and it's definitely not about some hidden knowledge. It really comes down to discipline. You see, the most successful investors, they all follow a proven framework. These 10 timeless rules that keep them safe when things get rocky and help them prosper when the market is good. And today, we're going to walk through every single one of them. Okay, let's start with the foundation. You wouldn't build a house on shaky ground, right? Well, it's the same with investing. These first three rules are all about building that solid base, getting your mindset and your strategy right before you even think about putting down a single dollar. If you get these right, trust me, you are already way ahead of the game. All right, first up, rule number 1, don't gamble, invest. This is huge. It's pretty much the fundamental difference between an amateur and a pro. So here's the thing. Real investing isn't about just rolling the dice and hoping for the best. Nope. It's about stacking the odds in your favor. And how do you do that? You look for the fundamental drivers of growth, things like areas with growing populations, big new infrastructure projects, and, of course, really strong demand from renters. If you can't point to exactly why an investment has an edge, well then you're not really investing, are you? You're just speculating. And that leads us perfectly into our next point. Rule number 2, forsake the advice of false prophets. You know, this quote really says it all, doesn't it? The media sells drama, not data. They absolutely love those sensational headlines about booms and busts because, let's be honest, it gets clicks. But that's not an investment strategy. Real long-term wealth is built by focusing on those fundamentals we just talked about, and by thinking about where the market's going to be in 10 years, not the next 10 minutes. Okay, this brings us to what might be one of the most critical rules in this entire guide. Seriously? Rule number 3, do your due diligence. This is a really crucial mindset shift. See, most people, they only focus on the upside, right? How much money they could make. But the smartest, most successful investors, they do the exact opposite. They start by obsessing over the risks. They ask, what could possibly go wrong here? And then they build a plan to handle those scenarios before they even think about buying. And here's the bottom line. If you don't fully understand all the risks involved, you simply shouldn't be investing, period. All right, so our foundation is set. We've got the right mindset. Now, let's move into the next phase, the strategy. Think of these next 4 rules as the powerful wealth engine that's really going to drive your portfolio forward. And we are kicking this section off with a big one. Rule number 4, let compounding work for you. I mean, there's a good reason Einstein was so blown away by this concept. Compounding is basically how ordinary people can achieve extraordinary wealth over time. It's that magic point where the growth of your asset starts generating its own growth. In property, that comes from 2 places: the value of your property going up and your rental income also increasing year after year. And this simple chart shows you exactly how powerful it is. Let's say you buy a property today for $500,000. Now, based on long-term historical growth rates, after about 10 years, that same property could be worth around $1 million. Pretty good, right? But wait another 10 years, and it could be worth $2 million. That's the power of compounding. It proves it's not about trying to time the market, it's about time in the market. Okay, next up we have rule number 5, and this is a really common trap people fall into. The rule is diversify, but whatever you do, don't diversify. So what does that mean? It means that diversification should never, ever come at the expense of quality. Honestly, owning a dozen so-so properties that don't really grow in value is way riskier than owning just a few high-quality investment-grade assets in fantastic locations. Always remember, quality trumps quantity, every single time. Now, let's talk about Rules 6 and 7 together, because they really are 2 sides of the same coin. Rule 6 is to invest defensively. Think of this as your financial fortress, your survival plan. It's about having cash buffers set aside and having the right insurance so you can ride out any storm or market downturn without breaking a sweat. Then, once your defense is rock solid, you move on to Rule 7, invest offensively. This is the fun part. This is where you proactively add value, maybe through renovations or even small developments, to basically manufacture your own equity and boost your income. You absolutely need both to have a complete, robust strategy. Okay, we've covered the foundation, we've covered the strategy. This final set of rules, this is all about adopting the professional mindset. This is what truly separates the successful long-term investors from pretty much everyone else. So let's get into rule number 8, avoid illiquidity. And this is a big one, something that a lot of people forget when it comes to property. Think about it. Unlike shares, you can't just click a button and sell a property in 5 minutes. It's what we call an illiquid asset. And because of that, having a cash safety net, a financial buffer, is completely non-negotiable. That buffer is what buys you time when unexpected things happen. And the pros? They always plan their exit strategy before they even get into the deal in the first place. Okay, on to rule number 9. This one is all about recognizing that you can't do it alone. It's about getting the right people on your team. And this is such an important distinction to make. Trying to save a few $1,000s by getting some free advice you found on the internet, that can easily end up costing you hundreds of thousands in mistakes down the track. Paying for high-quality professional advice from a proven strategist or a great buyer's agent, that's not an expense. It is an investment in your success.
And that brings us to our final rule. And honestly, this might just be the most powerful one of all. Rule number 10 is to invest in yourself.
Look, markets will change, regulations will definitely change, and the best strategies will evolve over time. Through all of that, your single greatest asset will always be your own knowledge. The time you spend reading, learning, and surrounding yourself with experts, that will pay you back dividends for the rest of your life. And the best part? Nobody can ever take that away from you. So there you have it, the 10 rules that guide the most successful investors. You see, at the end of the day, building wealth through property isn't about getting lucky. It's about discipline. It's about the systems you follow and, most importantly, the investor you decide to become. So the real question is, who do you want to be?